Welcome back to Personal Finance, Business 125. My name's Mr. Rankin. Let's go through a summary of Chapter 1. The intent of this is to just give you a brief summary. I only have 5 minutes on these tapes. And I just warn you, it's not a substitution for reading the book or studying the study materials, but it just simply provides you a quick overview of what's important in Unit 1. First of all, some of the objectives of Unit 1. We need to know why financial planning is important. A little bit about the goal setting process, a little bit about the planning process, the 5 steps of the planning process, and the 10 key principles that the author lays out on financial planning. So those are the learning objectives for this chapter. Let's get right into them. The first one, why is this important? Well, let's quickly look at the number of bankruptcies in the last 5 years. It's gone from 500,000 in 2005 and more than tripled to 1.6 million bankruptcies. That's about the number of people that will graduate from college this year. Secondly, if you look at the average credit card debt, it's gone from $3,000, almost tripling up to $8,000 per person of credit card debt. Now, if we paid the minimum balance on that credit card debt, it would take us 28 years. That's assuming we never charged another penny on the charge. So just paying the minimum balance each month, 28 years to pay it off. Other reasons, gives you a lot of freedom, a lot of aid in your personal life, and it gives you the ability to live a certain kind of lifestyle. All important reasons to do financial planning. So what are some of the steps? 5-step process. It's like losing weight or anything else. You establish where you are today. You define what your goals are, put together a plan of action. Of course, you got to implement the plan. And then you periodically review it and make tweaks and adjustments as events change. Quick note on setting goals or objectives. These are called SMART objectives. Objectives need to be specific, measurable, attributable to somebody, realistic, and time-bound. So let's give you a few examples. So establishing an emergency fund of $3,000, very specific, the amount, where it's going to be in my savings account, and it's time-bound, January 1st, 2013. Here's another example to pay off a MasterCard balance. Make sure your goals, if they're specific and measurable and time-bound, have a much higher probability of being accomplished than if they're just vague goals that really aren't well specific and well defined. Then the author talks about the 10 principles. First one is best protection is knowledge. Obviously, the more you know, the better off you can be. Just the fact, $1.2 billion in unclaimed IRS refunds last year. Money that the government owed us that nobody claimed. Nothing happens without a plan. Well, I guess I would say something happens without a plan. Notice the bridge. So planning doesn't guarantee success, but it certainly improves your odds. Time value of money. This is the concept that a dollar today is worth a lot more than a dollar tomorrow. This chart has an underlining assumption of an interest rate, which may or may fluctuate with time, but to be a millionaire, roughly $30 to $35 at age 20, then it increases dramatically. Notice it's over $1,400 by age 50. Now, these numbers are going to change, and you might see different ones in different books based on different growth assumptions. But that's really not the point in my mind. The point is if you start at age 20, it's just third as difficult as if you wait until you start at age 30. Then it gets more difficult if you wait another 10 years. So start early. Taxes affect your returns. This is the returns on a tax-deferred investment, which means you pay the taxes later rather than today. And you can see substantially better off if you can defer your taxes with IRA investments or 401k investments, which we'll cover when we get to that chapter. This is just another example of taxes. Over half the cost of a cigarette, this is in New Jersey, go to taxes. Principle number 5, stuff happens, have an emergency fund. Liquidity is the concept, how quickly I can turn an asset into cash. Have an emergency fund. Most experts will recommend 3 to 6 months of income. Spend your money smartly. Lots of people want your money. A lot of them will do things, refund anticipation loans. You do the math, you're paying over 100% interest on those. Protect yourself from major catastrophes. Here you can eliminate risks, get in the car, or most people will transfer the risk via insurance. Risk and reward goes hand in hand. The more risk, the higher the return. Mind games, everybody's out there wants your money. You need to be conscious of that. And the concept of pay yourself first. You're more important in any product, company. Make sure you pay yourself first. And the last concept is just do it. Go out there, get started. So I hope this helped. It was a relatively quick review. Again, my name is Mr. Rankin. And there's my email address. If you have any questions on Chapter 1, let me know, and good luck. Have a good week.